Good morning, everybody. Welcome to today's Morning Blast. It is Wednesday, the 21st of January. You join myself, Ryan, and of course, Michael, for the Morning Blast, where we give a very candid, we present a very candid podcast on markets, what happened yesterday, what's going to happen today. Well, themes, we can't exactly tell you the highs and the lows of price action, etc. We wish we could, and if we could, we wouldn't be sat here talking to you mugs. But a friendly reminder that this is all recorded live, so there is no editing if you are listening to this on the playback, so you don't get away with not listening to us swear and rant about random things. It's all very much uncut. Nothing we say is trading or investment advice, yada, yada, yada. Michael, how are you on this fine Wednesday morning? Well, I say fine, it's pretty grim where I am, but there we go.
Well, yes, very good morning to you, Ryan. Good morning, everyone. I was just about to say, once I finish this podcast, I'm going to go and build an ark, I think, such as the deluge of rain that we're getting here in the city of London at the moment. But nevertheless, we soldier on regardless.
You do.
Could be quite potentially quite an intriguing day, obviously, with President Trump and the accompanying hurricane arriving into Davos this afternoon.
Yeah, no, quite. I know I saw when I kind of woke up at don't know what time. I think I might have gone to sleep. I don't know. Back to sleep. Air Force One turned around mid-Atlantic and everyone was getting panicky. And
oh, yeah, all the conspiracy theorists are having a field day with that one, aren't they?
Turned out he got into a smaller plane.
Yes.
So maybe they realised that, I don't know, maybe Air Force One can't fit on the Davos runway. I don't know, but something.
Well, as one of my colleagues who thinks of themselves a bit of a wag said to me a moment ago, wouldn't it have been amusing if they had to divert and do an emergency landing in Greenland?
Oh, that would have been quite good. There you go. He could have come out with his flag. And
God, can you imagine?
Oh,
be like Buzz Aldrin on the moon.
Oh, exactly. One small step for Trump. Right.
One small step for the orange man, Russ.
Yes. Yes. One.
Sorry, that was terrible.
One giant leap for MAGA. Right, where are we? Market roundup. Let's start there with
Clive can restore some sense to the show, hopefully.
Possibly. This is not quite past me. He has mentioned the Dow again, so things in your ears. So yes, as usual, market update and important levels to watch by our good friend Clive Lambert over at Futures Techs. S&P, that hit 68.41 yesterday, bottoming out at 68.22 late on. Bid overnight back above 68.41. I, for one, am praying for a close of the gap on from Sunday or Friday night. The Dow futures gave a sell signal. 49,000 is now a key level to watch on a recovery. The DAX, that hit the 24,618 level that we cited yesterday and bounced. The low was 24,621, so a good level to watch there. Hats off to Clive for the level. Eurostoxx 50 futures also bounced from just in front of the short-term Fibonacci support at 5,844. FTSE, that's staying above 10,000, has nothing to do with the Labour government, no matter what they tell you. Bund futures, German government bonds, saw some dips buying, but it's still above 128.34. T-notes across the other side of the pond. T-note traders should keep an eye on the 111.20 to 111.22 on any recovery today. Just call it 111.21, Clive. That'll do you. Eurodollar traded up to 1.1768 after bouncing from its 200-day simple moving average on Monday. Bitcoin sold off further to 87,777. Big support of 84,000 coming back into focus. Broken record time. Gold and silver made more all-time highs again. What do all-time highs normally beget, Michael?
Well, more all-time highs.
There we go. It's like we planned it. Gold seems to be leading since we last wrote, though. Sorry, leading? Gold seems to be leading? Does he mean lagging? I don't know what's going on.
No, he does mean leading, actually, which, without wishing to entirely interrupt Clive, is an interesting one because actually for the last, God knows, 2 months, 3 months, gold has actually been lagging other precious metals. Sorry. So, for instance, gold is up 2% this morning, silver's up a mere 0.5%.
Tell you what is up a lot, and we'll come on to it slightly in a second. Let me just get the oil benchmarks out of the way. WTI and Brent still messy, although WTI failed at the 60.55 level, Fibonacci level that he's watching. Something for the bears to digest, maybe. Wash your mouth out, Clive. WTI's going higher. What has been going mad, and definitely has been going higher, is Henry Hub. It's gone completely bonkers overnight. And for Henry Hub, going bonkers, it's a high bar. So probably fast market stuff up well over 20% on last night's close. It's up over, Depends on what time you listen to this, because it is a very volatile market. Just now it was up.
It could be down 20 by the time you listen to this.
It was, when I last checked just a second ago, it was up around 30% since Friday. Well, yeah, Friday's closed basically. And anyone not understanding why this is, and I've seen some horrific reasoning behind it that obviously people have no idea what they're talking about. It's pretty much all to do with this weather that's coming in, this cold weather that's coming into the US. And it's increased the number of what you call HDDs, which basically means days they presume that the market will be turning on the heat and thus needing gas for that. And obviously, the more heating days you need, the more gas you need, and the higher the price goes. But Thursday's numbers, the Thursday storage data, will be quite pivotal, because there's some people calling for record drops in gas storage, which could be a fun one to watch regardless. So keep an eye on Henry Hub. I wouldn't recommend trading it unless you have experience, because it can rip your fucking face off.
And even if you do, still don't do it.
Well, exactly. I know some players that have had their eyeballs completely ripped out, and they're market professionals. Right. I do not miss trading that one. Proper fast market stuff, as Michael said, up well over 20% over last night. It's now got back a month and a half selling in 2 days. Bonkers. EU carbon markets continued lower yesterday to 83.52, but that has a muted start to life today. And on this side of the pond, TTF gas, that's Dutch gas, holding Fibonacci support at 33.60s to keep the bulls on top. One thing about that is we're getting to the point with Henry Hub that, and the demand is so much in the US, and the cold weather so cold, not only could we start seeing freezings, which basically means the gas pipes no longer work, but also some of this gas that is kind of predetermined to be going to LNG ports might be rediverted, and they might take a small hit or have to delay tankers, etc., because they can get such a good price here, or even they might not be able to get it down to where it needs to go because of the pipes infrastructure might be coming a cropper due to the cold, if it does get as cold as forecast. So I would be surprised. I just want to watch for the European gas. You might instantly think, well, hang on, it's thousands of miles away, but it's all connected to a certain extent. So beware if you are dipping your toes into the gas markets. But that's it from Clive. Well, me. Yes, Clive. Yes, Clive. Clive just WhatsApped me and Michael. He always sounds like he knows what he's talking about.
Well, that's why I paused. I was slightly speechless that you actually are sounding knowledgeable this morning.
Well, it's one of the few things that I've got in my locker.
Very few.
So thankfully, if we could just keep talking about this, that'd be great. But well, actually, no, because our subject du jour is also something I know very much about, which is overtrading. But we'll come on to that in a bit. Michael, what happened yesterday?
Yes, we will come on to that in a bit. In terms of yesterday, it was very much kind of more of the same in terms of markets from what we had on Monday. Although, of course, remember that the US was very much playing catch up, because obviously US desks were out on Monday for Martin Luther King Day. So yes, the S&P had its worst day since October. The Nasdaq had its worst day since November. But it's effectively 2 days worth of market moves as opposed to just one. And it's all still relatively controlled. It's all still relatively orderly. It is far from the end of the world. And this is, again, a dip that I would be seeking to buy into, because obviously we are fully working on the assumption that all of this Greenland stuff is a negotiating tactic from President Trump and not a threat that will be followed through on. The other thing, just to bear in mind, I think we did touch on this in the Morning Blast yesterday, is it wasn't just geopolitics that was driving markets yesterday. There was also that big sell-off that we saw at the long end of the JGB curve in the Asia session on Tuesday, which saw duration sell off more broadly across developed markets yesterday. Just to update on that, the 40-year JGB, which was up 29 basis points on Tuesday, fell 22 basis points today. So all of the people claiming that was going to be at the end of the world have suddenly gone very, very quiet indeed. And the other thing that might have just been playing on participants' minds a little bit yesterday was the Supreme Court in the United States. Of course, they issued opinions yesterday. Market participants still waiting for this ruling on the IEEPA tariffs. They did not rule in that case. And in fact, they have not yet issued another date on which opinions will be given. Although do bear in mind that the Supreme Court are due to go into recess at the end of this week until the end of February. So a ruling in that case could still be, 4 or 5 weeks away on that front. As for the geopolitical side of things, very briefly, we are basically still where we were this time yesterday. We are still having a lot of punchy rhetoric from the European side, whether that be Commission President von der Leyen, French President Macron, who was sporting a rather ridiculous pair of sunglasses in Davos yesterday.
Sorry to interrupt. Do we know what that's about?
Apparently, he's got an eye infection, but he looked like an absolute moron. I mean, mirrored aviators indoors. Do me a favour.
Yeah, like, I didn't know if he'd had snow blindness or maybe. I don't know.
Well, I thought it was AI at first. That's the point we've now got to in 2026. I can't actually trust whether the image is real.
I've done that about 4 times this week. I'm like, surely this can't be real, or this statement can't be real, or Trump on TV can't be real. But yeah, apparently
and then it is.
Yeah.
So yeah, we had a whole lot more punchy rhetoric from the European side. From the United States side, obviously, Treasury Secretary Bessent was saying that people need to take a deep breath and let things play out. He reiterated that language this morning. We also had US Trade Representative Jameson Greer speaking yesterday, saying that he thinks Trump might be, quote, setting the stage for negotiations. No shit, mate. That's kind of how this works. And we also had President Trump himself saying that a lot of meetings will be held in Davos and that he thinks things will work out pretty well. No real concrete developments on that front, but again, no escalation just yet. So I think as time goes on and as off-ramps continue to present themselves and as its rhetoric, its commentary, not action in terms of retaliation, I think markets should be able to increasingly move past some of the geopolitical noise and the hysteria and the hyperbole that we have been seeing and hearing over the last few days. Besides that, we did have a couple of bits and bobs of economic data over the last 24 hours. The monthly ZEW survey out of Germany came in considerably better than expected, with the expectations metric at 59.6, its highest level since July of 2021. Although do note, as we flagged yesterday, that the survey period for that report actually ended before Trump issued these latest tariff threats.
Yeah.
So take it with a massive pinch of salt, because you would imagine if they redid that survey today, it's going to be considerably less optimistic than that index would imply.
Quite.
We also this morning received our latest update on inflation here in the UK. Now, again, there's a lot of bad takes doing the rounds on this one. Headline CPI rose 3.4% on an annual basis in December, a touch above the market's expectation of 3.3% and also above the prior 3.2%. Core inflation, meanwhile, that held steady at 3.2%, while services inflation, that also ticked higher to 4.5%, up from a prior 4.4%. Now, before anyone gets too concerned about what's going on in terms of UK inflation, there are 3 factors that are primarily driving, the uptick that we saw in December. The first is higher alcohol and tobacco prices, and that stems almost entirely from the increases in duty that the Chancellor announced in the budget in November. The second is food prices, which rose by about 4.5% on an annual basis in December. But that's well below the Bank of England's forecast, which was at 5.2%. And the third and most important upwards driver of inflation in December was airfares. Airfares rose by 28.6% on a month-on-month basis in December. Before anyone goes long airlines on the back of that, thinking they're profiteering, that is simply due to a statistical quirk. The ONS conducted the data collection for airfares, and the date that they referenced was outbound flights on the 16th of December and return flights on the 23rd of December. What happens in the week before Christmas? It's a very, very busy period for travel, and airfares are considerably more expensive than they otherwise would be because demand is through the roof. As a result of that, it's obviously skewed the overall inflation metrics higher, but when they do the survey in January, that will all unwind again because prices will be back at a much more normal baseline. As a result of that, the data that we got this morning is very, very noisy. It is statistically skewed ultimately because of how the ONS have conducted their data collection. And it's also likely to have very, very limited policy implications. The Bank of England will not be setting interest rates based on what airfares were in 1 month.
And also, remember, this is the ONS, so data gathering isn't exactly their strong suit, which is slightly depressing because that's their only job.
Well, exactly that. But there we are.
This does make a good case for the fact it's something that I've always tried to explain and tried to say, but it's easier said than done. It's why I like data points such as the weekly Thursday jobs number that we get in
jobless claims.
Yeah, jobless claims and continued claims and initial claims, etc. But they give you the 3-week average 3 or 4 week average.
4 week average.
They give you the 4 week average, which I prefer that kind of data. I like it smoothed out. And I think if more people, because it's, we know that's what policymakers look at. I think it's very easy though to get caught up in like one data set, especially over Christmas, New Year, when you get some kind of ricks flowing around, kind of like some outside numbers and whatnot. But yeah, it's always good to take a step back and say, well, look, what is the 4 week average, or what is the 4 data set average?
Well, actually, on that note, I haven't done this myself. I've stolen it from Callum Pickering at Peel Hunt because he did it before me, and I'm not going to do the work again.
Follow.
He is a very, very good fellow. He's a lovely chap as well. On a 6-month annualized basis, inflation has now actually been below the BOE's 2% target for the last 2 months in a row. So again, just smoothing out some of that noise. And this noise is going to continue for quite some time. Obviously, we're going to have a base effect skewing the numbers lower in the early part of 2026, which is why the bank expect those headline inflation metrics to return to 2% in the spring of this year. But again, it just helps to take some of the noise out of it. So a lot of people are running around going, oh, inflation's sticky, services at 4.5%. I think we'd all admit services inflation is still running too high. But it's at that level because of statistical quirks.
Yes.
And if you zoom out, the direction of travel is lower. It is towards the bank's target. And especially when you add on top of that the labour market data that we got earlier in the week, yesterday, in fact, there is a margin of slack opening up in the labour market.
Yeah.
Private sector earnings growth is at 3.5%. That's roughly compatible with the bank's inflation target over the medium term.
It's just a shame that unproductive public payrolls are screaming higher.
Well, exactly that. But again, you would expect that to kind of fall out the data into the early part of this year. So don't overreact. Well, there is that. Yeah, that's a very good point. So yeah, don't overreact to the UK inflation data. And also, if anyone's wondering why cable just did not move, obviously, textbook is hot inflation, hawkish policy, cable rallies. Well, it's not going to happen when everyone knows that this statistical quirk was going to impact the data. Just 2 final things from me before we move on to our sort of debating point for today. Firstly, in a frankly moronic decision, the UK yesterday decided to grant planning permission for this humongous Chinese embassy in the City of London. For anyone who is aware of the geography of the City of London, this embassy is going to be built at Royal Mint Court, which, if you come over Tower Bridge, the Tower of London is on your left, Royal Mint Court is on your right, and it sits about 3 foot, or the boundary of this embassy sits about 3 foot away from some very important telephone and fibre optic cables that connect the city to Canary Wharf and all of the data centres there. I'm not suggesting that there is a nefarious intent behind this, but I'm also going to say that it's probably no coincidence that the Chinese bought that site for their embassy.
Just one thing on this. You got these things have got to be forward planned, right? Because yes, it might be a case of right now we don't think the Chinese are doing anything, but you don't know what our relationship with the Chinese is going to be in fucking 6 months' time, let alone
why take the risk?
In 10 years' time, the world could be a very different place. And you've literally parked, and they've got, it's marked on the plans as a secret room in the embassy, like 3 foot away from some incredibly critical fibre optic cables that kind of contain a lot of sensitive information through the heart of London. Now, whoever's agreed this, well, what are you doing? But anyway, look, that's a whole nother show.
I was going to say that we can leave it. Keir Starmer is going to China, I think, next week. So maybe we can discuss that in more detail then. He's also going to be visiting Japan on that trip. And that is the last thing I wanted to mention, because we did hear from the Japanese Finance Minister, Katayama. She was speaking in Davos yesterday. She said that she would like markets to calm down. You speak for us all on that one, love. She was also saying that that FX intervention remains an option, but that she is unable to say if it is about to happen. Of course, she's never going to pre-commit to that in advance because everyone will front run it. However, dollar yen has pulled back from the recent highs. The high that we saw in dollar yen last week was just north of the 159 mark. We trade south of 158 today, despite the volatility that we've seen in JGBs. So perhaps you would argue that actually that intervention risk is a little bit lower than it was this time last week. But for the time being, that's all from me.
Lovely. Well, so today's talking point, and it's an issue that impacts pretty much every trader I've ever met, and unfortunately I've met far too many, and it's overtrading. And it's why overtrading destroys returns and destroys careers to a certain extent. So what are we talking about? Well, most people would make more money if they traded less. That's the soundbite, and it sounds very obvious, but why does everyone keep doing it regardless and keep overtrading it? And it's really because your brain is wired to trade, and the market is designed to let you. So, I think the easiest way to break this down is 4 psychological traps that do impact this. And obviously there's many more, but the main ones are action bias, which is, we're wired to act even when doing nothing is optimal. Sitting still feels very much like failure. And this is proven with some studies they've done with actual professional goalkeepers. It would make more sense statistically just to stand in the middle of the goal when a penalty is being shot towards you, but most of them dive left or right. Statistically, if they stand in the middle, they'll save more. But again, it does feel like failure if you do nothing. The dopamine loop, which is where trading activates the same neural pathways as gambling and drug addiction. So, it's the anticipation of a hit. And there's actually been some research to say that a near miss or like a small loss actually gives you a bigger dopamine hit than a winning trade, which is quite bizarre. Number is the illusion of control, i.e., markets are outside of your control, no matter how much you disagree with that. Unless you're trading a gazillion lots and moving markets, they are outside of your control. But putting a trade on does create somewhere in the back of your mind a feeling that you're managing the outcomes. Just a reminder, you're definitely not. And the fourth, and I think this is a massive issue with social media, and this is why I want to finish with this one, and this is why I think Michael will very easily lead on from this, is the highlight reel effect, which is social media shows literally just the win. And they don't show the hours of waiting. They don't show how much you sit on your hands. They don't show the amount of times being stopped out or this, that, or the other. And it's very easy if you're glued to your social media, be it Instagram or TikTok or Twitter, etc., just to see a million different highlights from a million different people and think that it means that everyone's winning all the time, which they really are not. What are your thoughts on this, Michael?
Well, I think that last point, excuse me, is absolutely spot on. Don't anyone posting trading statements or screenshots or anything like that on Twitter, either unfollow them or if you like me, just block them, because there's absolutely no need to see that sort of thing. Cost of carry doesn't exist on FinTwit, as we've said for years. And it seems these days that losses don't exist either. You should really be benchmarking your performance against yourself, not against some random on the internet.
Can we just flag that it was yours truly that came up with the cost of carry doesn't exist on Twitter?
Was it? I thought it was polemic pain, but okay.
Oh, it might have been actually. I might have stolen it from him, but I remember I've used it a hell of a lot.
I was going to say, if you want to claim that one, then you absolutely can.
I nearly said Paul's real name there, but no, it probably was Paul.
Well, so did I, which is why I stopped myself.
We've said it before,
that isn't his real name, but we're not going to tell you what it is.
And if he is listening, he is a pain in my ass.
But no, I think you've absolutely hit the nail on the head there in terms of what you covered. It's very much human nature is to basically just do something. You sat there looking at charts, looking at news flow, listening to headlines come in over the squawk all day long. Yeah. It's natural to kind of go, I need to react to absolutely everything that I see. But actually, that's completely the wrong way to look at it. You once you have a trade idea, once you have a thesis behind that trade, go and stick to it. Absolutely. If news comes in that changes that thesis, then you change your trade. You come out of it, whatever. But in the meantime, I would say 90% of what people react to is probably just noise, and it does not need to be reacted to. And I've actually pulled some statistics from a retail broker who will remain nameless.
Sorry. Carry on.
And we're just giving away who that is. But overtrading is a lot more common than you would think. So the median client for this broker, whoever they are, that trades gold, holds a position for a median time of 2 hours. And the mean, if you bring it down to an average, is 5 minutes. Now, I'm not going to stand here or sit here and critique people's trading strategies. But if you're in and out of gold positions in, 2 hours, let alone 5 minutes, you are overtrading, frankly, and you are not giving those trades enough time to actually develop. You're probably cutting winners too early. Certainly, you are overtrading, and you're going to become a drag on profitability, not only because you're never letting those positions breathe, but also because any profits you do make, you end up paying it away in spread and commission anyway.
Yeah, no, absolutely that. And exactly. And the thing is, again, it comes. I think the action bias is something that really impacts people because they feel like the more they trade or the more they're involved in the market, the more diligent they are. But you'll get punished for that. And I do like one kind of trading cliche, which is your portfolio is like a bar of soap. The more you handle it, the smaller it gets. Obviously, there's a smutty version of that, but I'm not going to.
Sorry, my immature mind has run away with it.
No, but as soon as you word bar of soap, you lit up, didn't you? Anyway, like I did do a blog post yesterday because it basically stemmed from a conversation I had with Lord Fed on X, who's also a very good follow. But do check the article out that we posted. I actually might put all these articles I'm doing into a Substack thing or whatnot. But also we'll put up I've done another infographic for it as well, so we'll put this up afterwards. But honestly, if you are sitting there as a retail trader and you are struggling and you are fairly new to this, do have a look at how much you're trading. Honestly, I think one of the best things you can do as a new trader or a trader in general, and it's an easier said than done one, but promise you that people that do this, in my experience, and I know a lot of successful traders and I know a lot of failed traders, journal. Write down, journal why you're going to do a trade. Don't do it afterwards and make up a reason. But if you feel like you're going to do a trade, write down the reason why you think you're going to do it before you do it. And often, and this will sound bonkers, trust me on this one, often just by having to force yourself to write it down, sometimes if you're not really committed to it, you can't be bothered to write it down. You won't do the trade.
Yeah. And also,
yeah, go on.
Just lastly on that, you are absolutely spot on. We do need to do the day ahead, but we could probably do a separate thing on journals at some stage, maybe a Friday morning. But I will just say right now, a journal is not just a list of trades.
No,
you can get that from a P&L statement from your broker. Yeah. A journal is the rationale behind the trade, why you put an order where you put it, why you put a stop loss where you put it, what was going through your mind when you took that, how you determined your position size, all that stuff, which we will at some point cover in the future, I promise. But don't just write down, I went long cable at 134 with a stop at 133.
Exactly.
You can get that in 10 seconds from your broker.
That is a hugely important distinction to make. So that's very well done by you. Yeah, exactly that. I know people that come in the morning and they've got like a little emotion chart and they've got one every day and they put a cross through the one they're feeling at the moment. Oh, this is obviously hitting home with a few people because we've had a few. Well, I've had a few, and some of them on the groups that you are from WhatsApp people that are listening live. They're all saying, "Yeah, exactly that." So look, trust us. Learn from mistakes that I've made, mistakes I've seen other people make. But honestly, this will turn your trading around if you can trade less, journal more. I promise you that you're at least swinging the scales in your favor, even if it's just a little bit. But anyway, enough on this for now. But I hope it's helped some people. And again, I'm going to put the article out and put some more infographics out about this. So do keep an eye for that. But Michael, what is going on for today?
Yeah, in terms of today then, I mean, geopolitics is going to be very much in focus once more. The data docket is quite light. We only have the latest pending home sales data out of the States, and that's due at 3:00 this afternoon, London time. There's also 20-year Treasury supply a little bit later on as well, although do bear in mind that the 20-year is a very, very unloved segment of the curve, so don't read too much into those auction results.
What do we put? It's the ginger stepchild of the president.
Indeed it is. In terms of what to watch today, though, obviously all eyes will be on the World Economic Forum in Davos, particularly the scheduled address from President Trump. That is still on the docket for 1:30 this afternoon, London time, although given those travel issues that Trump's been having, it could be delayed. We do not know at this point, but do bear in mind that timing is obviously subject to change. Other than that, we are due to hear from the ECB President Christine Lagarde at some point, which I'm sure will be thrilling. And also on the subject of central banking, at 3:00 this afternoon, London time, the Supreme Court will hear oral arguments in Fed Governor Cook's challenge against her dismissal. They will not be issuing a ruling on this for some considerable time, but the arguments may attract some interest, as they could potentially give a bit of a steer as to how the Supreme Court justices are looking at that case. And of course, participants will continue to keep a very, very close eye on incoming news flow as well, particularly not only in Davos, but all of the various other geopolitical shenanigans that are going on at this moment in time. But that is all from me.
Indeed, and it's all from me. Very good show today, and it looks like we've got some very good feedback already. So I'm really glad that we've managed to help people on that. Just quickly, I know we're running over time, but potentially, Michael, I don't know what the diary's like next Thursday, but potentially for London-bound people, we could have some beers because we know our dear friend Tom's around.
Well, I shan't be there next Thursday, as I've already told you. But don't let that put you off.
I didn't read that message. Sorry.
You clown.
Well, I might be around and Tom might be around. There you go. But anyway.
Well, there you go. It's cheaper on my corporate cards.
Oh, God damn it. Right. That's off. We'll do another week. Michael, thanks so much as always, listeners. Hope we've added some value and put a smile on your face.